The agenda today, what I'd like to do is kind of start off with the 30,000 foot view and then just kind of zoom in as we go. I'm going to cover some stuff that you might know already. So if at the beginning it's a little too simple for you, just wait a little bit. So the first thing that I want to talk to you about is really just looking at the very broad view of the financial industry. Okay. The financial industry, if you were to oversimplify what it looks like, there's really only three client-facing entities. There are the broker-dealers, and these are the companies, a lot of them that you've heard of: Merrill Lynch, Morgan Stanley, Goldman Sachs, UBS, all of those companies, Raymond James, there's tons of them. And then there are registered investment advisors. Now, we lovingly call these folks RIAs for short, which is, of course, what we are. And then there are insurance companies. Now, my father taught me a great lesson when I was a kid, taught me quite a few, really. But one of those was that anytime you want to know the truth about something, follow the money. You know, figure out how somebody gets paid, and you'll figure out their motivations for their actions. And it works 99% of the time. And really, there are a number of differences between these types of entities. But ultimately, what I would point out first is how they get paid. A long time ago, broker-dealers operated primarily on commissions. A lot of you might be familiar with commissions. Essentially, it's a situation where you go in and you purchase $100,000 of IBM stock, and that financial advisor collects a 5% commission, which comes out of your money. And now that you've done that, you have $95,000 of IBM stock. Registered investment advisors primarily operate on fees, which is typically a percentage, for instance, 1% of the assets you're managing, which is advantageous for both the advisor and the client these days. But for the client, from the client's perspective, it's because, you know, if the advisor does well and the account grows, then the fees grow. And likewise, if the account falls, then the fees go down as well. Insurance companies also operate on commissions. However, it typically does not come out of your funds. So unlike the example with the broker-dealer, if a 5% commission is paid to the advisor, that is paid out of the pocket of the insurance company. However, it's important to recognize that that commission is still factored in to all of the numbers behind the scenes. Now, I think more important to just looking at the fees and commissions and how they get paid, I think it's also important to look at their responsibility to you, right? So broker-dealers and insurance companies both use what's called the suitability rule set. Okay, suitability means that as long as an investment recommendation is deemed suitable by the compliance team of the firm, then it is okay to offer it. Whereas registered investment advisors operate as fiduciaries, which means that as long as it is, if the advisor is able to prove that that is in your best interests and deemed suitable for the client, then it is an acceptable transaction. Interestingly, what happened with this whole situation is, it's just a little bit of a history lesson. I won't spend a lot of time on it, but you know, a number of years ago, several decades ago, clients started to kind of figure out that fees were better than commissions. Because with commissions, there's more of a conflict of interest. You know, the advisor's already gotten paid, and whether or not you are successful at that investment is really not as important as it would be to them if they were collecting a fee. So clients started kind of moving away from the large broker dealers and started working with the registered investment advisors. And interestingly enough, of course, the broker dealers have a lot of power, and they said, well, we can't have that. So they became what's called a hybrid, which is what most of them are today, where they're both a broker dealer and a registered investment advisor. Now, of course, when they first did that, they became fiduciaries. And of course, it is actually, you may or may not know this, but it is actually generally less profitable to be a fiduciary. And that's because, you know, and many of you are older and wiser than me, this is not a surprise to you, but generally there is a sliding scale of benefit between the industry and the client. And if that scale is, over in the client's area over here, then that means it benefits the client more and it benefits the industry less. And likewise, if it benefits the industry more, it benefits the client less. This is just a simple fact because there's only so much money to go around.
Click the card in the corner of the window to continue this webinar. Please remember to like this video and subscribe for more educational content.